Todd, congratulations on your appointment and welcome to Tax Vibe.
Thanks, Robyn. I'm really pleased to be here today and looking forward to what 2024 has to offer.
Kicking off the year, but before we get into all the business side of the conversation, how did you spend your summer? Did you get some downtime?
Look, I did. It's actually been a really enjoyable summer. Spending plenty of time actually away from the world of tax. Time with family and friends. Had some family come out from the UK to visit us, which was wonderful. Time with the kids. Went to the cricket, been at the beach, catching up on a bit of DIY around the house, that sort of thing. So packed in plenty of stuff over the last few weeks, but looking forward to getting into the world of tax again.
Sounds like a good Aussie summer. So we had a big year last year, and I hope that practitioners around the country have had some time out and an opportunity to relax and reset, recharge, reinvigorate. We come back into the new year, and as we do, what sort of reflections briefly can we cast back on 2023? What are the learnings, perhaps at a macro level?
I think it's been an interesting few years, and it's continued to build. That you've had a whole range of cost of living pressures that are being felt, rising interest rates, that type of thing, inflationary pressures, and that's built across a broad range of people. And we have multiple speeds in the economy, I think it'd be fair to say. Some are really feeling the pressure on the household budget, others perhaps not quite as much. But I think if we're looking more broadly, the tax system and where that heads to help people out, to have some more fundamental changes to the tax system, it'd be great to have some genuine tax reform on the table there. But I think we've got enough interesting areas or evolutions in the world of tax this year that it's certainly not going to be a quiet year in the world of tax.
I was just reading this morning, there's been another construction company that's gone into administration this morning down here in Victoria. And I'm wondering, with all the government support that was provided during 2021 and even into 22, is it 23 and 24 we're really starting to see the impact and will continue to see the impact, perhaps of the post-pandemic and the fact that the government support has come to an end?
Look, I think that's right, Robyn. I think businesses needing to stand on their own 2 feet, so to speak, and some of those things washing through the system as far as the catch-ups where businesses that perhaps have overextended themselves, or they've got labour market shortages that are hitting their workforce and their ability to fulfil contracts and doing it cost effectively. I think all those types of things are really starting to hit, and probably, much like myself, getting a bit of time away from the profession that I operate in day to day. A lot of other business people will have taken the opportunity over the summer to have a little bit of downtime, probably reflect on what has happened with their business and where their business heads moving forward, and whether they need to make some difficult decisions leading into 24. Or be prepared for difficult decisions that might come. And that's never pleasant. But I think there's also a lot of really positive decisions that people could look forward to this year, and opportunities that, as the saying goes, never waste a good crisis. So opportunities also come out of this type of thing. So I think a lot of people will be ready to step up in their profession and move forward with a strong 2024 and beyond.
I'm particularly interested in delving a bit more into the shortages with the workforce. We'll come to that in a moment. In terms of 2024, what do you see as being the really important factors at play? What's going to shape the landscape of 2024?
Oh, look, I think, as you say, we'll come back to the labour shortages in the profession and more broadly, but inflation is something that we saw, obviously, over the last couple of years. There was some fairly significant inflation. That's, appears as though it's starting to ease, but how quickly does that ease? And what does that do for clients, for businesses, for pricing, for household budgets? And also dovetailing into that, where do interest rates go? And I think, have they capped out? Is there further increases, or will we see some cuts later this year? It's a fascinating little interplay there with what that means for borrowing capacity as well, be it for businesses looking to invest. And we've obviously had certain government measures, instant write-off, temporary full expensing type things that have meant a lot of businesses acquired a lot of capital assets. But the ability to borrow for those sort of things now, where's the borrowing capacity for future acquisitions of capital assets, albeit perhaps they aren't as tax effective now with the changes to the instant write-off type measures, but still businesses looking to keep themselves at the forefront of their industries. So I think that's an interesting part. As you mentioned, Robyn, the government support and the ending of that. What will that actually mean? Businesses needing to manage an environment where they need to be able to fend for themselves and genuinely be able to push a path through without those levels of support. And that will be tough for many of them. I think you've also got the mortgage cliff that's been talked about, and fixed interest rates coming off, people who are on these 2% interest rates or sub 2%, some of them rolling on to 5, 6, 7% interest rates. What does that look like? And same as business borrowing. What sort of interest rate are businesses borrowing money at, and how does that flow through? So I think those things are certainly going to be interesting during the 2024 year. But those businesses, those clients, those taxpayers that have managed through sensibly, they'll be able to work a path through this, and it's all part of good business management and economic management. Household budgets, business budgets, all those type of things. So certainly those are some of the things, and perhaps, Robyn, we touch on this labour shortages aspect now, because I think that's probably one of the biggest things that is ahead. Is the labour shortage dovetailed in with what impact does AI have on the profession? So, labour shortages more generally, I think, across the economy, the tax tax and advisory space is certainly not exempt from that. We're seeing those shortages where people are trying to recruit more people to assist, but it's proving very tough. And it's not just those people who are running businesses out in the regions and the suburbs. It's everywhere that trying to get good quality people isn't easy. And so that's not going to solve itself magically just because we've all had a Christmas break.
But the idea of upskilling and training staff and looking at alternative pathways. In an upcoming podcast, we're going to be chatting with Frontline, who are experts in offshoring. And that's going to be a whole different conversation about how do firms actually resource it using labour that is offshore and how do you control all that. But if we come back to the Australian market for the moment, the courses being studied, are we still getting people wanting to embrace the accounting and tax profession as a career? The traditional pathways where you had a job for life, where you stuck with this career and you might have changed jobs 4 or 5 or 6 times. But that doesn't necessarily look the same anymore. And we've got people who are exiting the profession. Now, whether it means they're going off into industry, meaning they're still an accountant, for example, but they're simply not working in public practice, or whether they're actually exiting the profession entirely. It's an interesting landscape.
Look, it sure is, Robyn. And I think if we look more generally at businesses and that there's new businesses, technology, everything else that has meant that the breadth of skills needed to assist and advise those businesses has evolved over time as well. And the tax profession is one where people from different backgrounds, not just their cultural backgrounds, but also what they've studied previously, what they maybe haven't studied, whether they do need to upskill in certain areas of tax, whether they're specialised in areas. I think it is something that we have got an evolution of what that looks like, and perhaps people are looking for different things than perhaps people in previous generations did. The tax profession, though, is still one where there's many, many hugely interesting and exciting things to look at in all areas of tax. But I think your key thing there, Robyn, about upskilling and training is really crucial, that it doesn't matter the background. If someone is keen and they are bright enough to do it, they can do the study, they can upskill, they can train and bring themselves up to speed and be able to be a really well-equipped advisor to be able to provide the sorts of things that clients are looking for. And that's exciting. I think as a profession, I think that the breadth of skills that different backgrounds bring can actually make the profession more vibrant moving forward. And I think that'll be a fascinating thing to play out over the next generation or two.
Can you you comment on cultural shift? And I'm not just referring to working from home, although that's a big part of it. Are we seeing changes in the way that an aspiration to be a partner in a firm may not be the driving motivation for young practitioners? Maybe they do want to progress, but they don't want to take over the ownership or the capital, the equity or the responsibility of running a practice. What are you seeing out there?
Look, I think there's certainly still a strong amount of people who do aspire for that partner type thing, but there's also a large amount who perhaps that's not for them, and there's nothing wrong with that. That's actually, as long as it's clear to everyone and the balance is right, there's nothing wrong with people wanting the balance in their life and perhaps the changes of their career throughout. I think I certainly enjoy my week. Yes, there's plenty of hours worked in my week, but I also enjoy going and coaching my kids' sports teams or taking them to swimming lessons. Every couple of weeks there, going to see them, and that's a part of my work-life balance that actually helps keep me sharp for the time that I am focused on working on client matters or doing tax related things. So I think that the evolution of you're not chained to your desk. If perhaps there was a perception that that was the only way to be effective, I think that shift is an important one. But the work-life balance and what that phrase actually means, I think, is a really important one. And getting that right for everyone and making it clear between the employer and the employee that hey, they might aspire to be a partner, but that doesn't mean they have to work ridiculous hours every day of the week. Getting that balance right is important. So I think we'll continue to see an evolution of it, Robyn. As you say, the work from home is a part of that, the flexible working hours, those types of things. I think it's just something that will continue to evolve.
In terms of the role of technology, some firms have embraced it. Others are still perhaps a little more resistant and like to do things the way they've always been done. There are certainly some great tools out there. But if we look at, for instance, ChatGPT, and in terms of it being a useful tool, productivity, more efficient, but is it any way in terms of detracting from the quality of what we bring as professionals with the expertise and the experience? Can it make decisions? Can it judge ethical dilemmas? It's an interesting question about how AI can be used in a practice.
I think you could open up a Pandora's box here, Robyn, of things. But technology, there is no doubt about the fact that technology, if harnessed correctly, is very powerful in the world of tax, be it whichever part of tax you're coming from and what your job description or role actually is. But the efficiencies that can be driven there, if you understand the process and what you're actually trying to get the technology to do, I think is critical. And you take your chat GPTs and that, they can be very useful, but don't expect them to give you a completed solution to a problem. You still need to have the technical nous in the background to be able to identify whether it's complete and correct. It may be that something that ChatGPT has put out is somewhat correct in a particular context, but is it actually fit for purpose for what you're actually trying to achieve? So those types of things, I think, is where technology has a place, and will continue. It obviously, AI will continue to get better and better, one would assume. But the real skills that experienced and keen tax professionals have, that'll be very difficult to replace the breadth of what that is. And as you say, Robyn, the ethical dilemmas, there's often those require a judgment call that is far from easy in many instances. And sometimes you need to discuss that with others and take on board different views to come up with a solution to a potential problem. And a lot of people in the world of tax, their role could probably be more aptly described as a problem solver rather than a tax person. And problem solving requires the same core process, irrespective of whether it's a tax issue or an ethical dilemma, or whether it's something you're trying to, as I've been doing, trying to fix around the house, a few DIY problems and whatever else. You've just got to come up with solutions using a process to get there. So I think technology is something that 2024 technology is only going to become more powerful, but people need to understand their process and make sure they've got an efficient process, because the old adage of garbage in, garbage out probably still applies pretty well there, that if you haven't got the right systems and processes, your technology is not really going to help you in the way that you perhaps think it will.
It's also important to check the veracity of what it is you're reading that is produced by AI. I heard of a lawyer who was provided with some research, and the precedents that were discussed in this research were compelling and persuasive, and it was all very well put together. And of course, he did his proper due diligence and make sure that he checked that this was all correct. And the cases that had been described in this artificially intelligently produced document was in fact all made up. So it is important that just because you're provided with something from the computer may not be correct.
Well, that's one way of supporting your technical arguments with things that exactly fit the fact pattern. Never let a good story in the way of the truth, eh? So
that's it. All right, so moving into our space, looking at what's on the radar from a tax perspective in 2024. The most dominant discussion at the moment, and not just because of the timeframe coming up, we have, of course, got the federal budget. And it's this annual gathering. I'd describe it nearly as the most exciting night of our year, where, of course, at the Tax Institute, we all get together. We spend the night poring over the budget papers and producing reports and summaries and videos, etc., for our members and the broader profession. But it is the 14th of May this year, scheduled at this stage. And certainly the focus is on the stage 3 tax cuts. So it's worth making the point that these were legislated back in 2018. It was a 3-stage approach. Stages 1 and 2 were deliberately targeting the lower and the middle income earners first, and it was always intended that the stage 3 tax cuts, delayed until 1 July 2024, would target the higher income earners. Now, in order for them not to proceed, the government would need to change the law. So they'd need to get the support of the Parliament to actually put some amendments through. We will watch and wait with great keenness over the next few months to see how this plays out. And I'm not interested particularly in getting into the political arguments here, but certainly it is dominating headlines, and cost of living relief is something that the government has undertaken to provide in the budget. Your thoughts on this?
I think, Robyn, you've got, obviously, as you mentioned, this was legislated a number of years ago. So this is not something that requires a budget and future passing of legislation. It is locked in. So there would have to be superseding legislation to go and change those tax cuts. What we've probably got is the fact that we're not in that extreme deficit position that was perhaps forecast as little as a year or two ago, largely because of the natural resource prices and the strength of the tax inflows that have been coming in. So I think that means that there perhaps is the ability to have the stage 3 tax cuts just continue to flow through and happen in 6 months' time when they're meant to kick in, but also provide some cost of living relief for those lower income to middle income earners who perhaps are finding it tougher. So it's something that I think the federal budget, as you say, it's a really exciting night for a tax person, and reading through it, I'm not going to sit here and lie about that. It is always interesting whether there is a lot of changes or whether there are not, and the speculation around why or what or so on. So I think it would be nice, obviously, irrespective of political party, to see some bold tax measures. But I think the budget position being where it is, there probably is some room for them to provide certain reliefs there, perhaps that weren't as readily available without going into even bigger deficits. As I say, because of those natural resource prices and that type of thing that has assisted.
Yep. And we are in the process of preparing our pre-budget submission. So this is an annual process. Again, the government calls for this each year, and we're gathering feedback from our members and putting this together to let the government know what our thoughts are on what they should do in the budget.
That's right, and I think we're always looking to make sure that the tax system is fit for purpose, and some of that involves measures that are a bit more future looking rather than perhaps political type measures, and so I think trying to find the right balance but putting it forward to the politicians to make sure they're at least considering some of the things that we believe as an institute and as a tax community are worthwhile to consider.
So perhaps my tip to those who are interested in budget night: cancel all your social engagements unless you're going to spend the evening with an accountant or a tax lawyer. Order your pizza and settle in for an interesting evening.
I think the pizza delivery companies and the different pizza companies, that must be a real kicker for their night, that they now would know that it's the accountants and the tax professionals that are ordering big from that Tuesday night each May each year.
All right, on to another really significant development for those in the SME side of things. We had a tribunal decision last year, and when we look at the decisions that come out of the Administrative Appeals Tribunal, which, by the way, is in the process, of course, of being rebadged and redesigned as a new Administrative Review Tribunal, and that's going to come further on down the track. We've got a decision that deals with unpaid present entitlements. Now, you and I, and of course, members of the profession have been talking about UPEs for about 15 years now. So it was 2009 when they particularly came on the agenda. And all these years we've been having debates about whether or not an entitlement that is made from a trust to a corporate beneficiary is in fact a loan for Division 7A purposes. We've had various forms of ATO guidance. It's been reshaped and it's shifted and it's adapted and been extended. And I won't go back through all of that guidance that has been issued. But this decision, Bendel, has certainly grabbed our attention, and it is now an appeal to the Federal Court. Perhaps can you describe a little bit more about the case, why it is so interesting to us, and what it could mean if indeed, having had, of course, a taxpayer win in the tribunal, the tax office has appealed this up to the Federal Court. So what happens next?
Look, this is certainly one of the biggest things in the SME tax space for 2024, Robyn. There is no question about this, because as you mentioned, for the best part of 15 years, we've all been having to focus on distributions from trusts to corporate beneficiaries and how to deal with those distributions. Do they need to physically be paid? In previous years, could they be put on sub-trusts, interest-only facilities, all sorts of things like that. This decision certainly, I won't say it flips that on its head, but it certainly brings the technical issues to the forefront, and something that a lot of people are probably saying, well, why has it taken so long to get here? These technical issues, we've had the ATO's view for well over a decade now, or their broader view that's evolved over time there, but practitioners have had to either put their clients and themselves potentially at risk if they're taking a more aggressive approach, or take them perhaps what some may say is the more conservative approach, consistent with the ATO view, and paying those distributions through to corporate beneficiaries or putting them on Division 7A complying loan arrangements, that type of thing. So this issue, I think, will be fascinating as to where the Federal Court decision goes. And if it goes in favour of the taxpayer, do we see legislative change? Do we see it reach the High Court? If it goes in favour of the tax office, again, do we see it going to the High Court? Where does it go? But probably more broadly, what does this mean for distributions in recent years, where people are having to, either clients or their advisors assisting them in making decisions on what do they do with these distributions that are from trust to corporate beneficiaries? What does it mean for tax planning for 2024, for the June 24 distributions? And I think it's probably too early right now to make a definitive call on what people should or shouldn't do. But unless we get a decision over the next few months, which probably may take more time than that, the probably do have a really interesting next few months as to, well, will some clients push for their advisor to say, hey, can we take a more, less conservative approach this year than what we did previously? But does that come with a risk that if the Federal Court decision is in favour of the Commissioner, what does that mean for those distributions? So I think this is a really interesting in the tax planning space, and also the use of trusts, where we've obviously had a whole range of trust-related matters in focus over recent years. This one was, was one that had, I won't say died down, but it certainly has not necessarily been the focus until the Bendel decision came out. And now I think it's going to be a fascinating year on this front, Robyn.
It's important to remember this is an administrative decision at this stage. So, in other words, when the tribunal makes a decision, they're not changing the law. They're simply standing in the shoes of the Commissioner and remaking the decision that he's already made. But in this case, it was different to, of course, what the Commissioner had decided. When it goes to the Federal Court, or it could in fact go straight to the full Federal Court, we will have proper case law. And then, as you say, it's a case of whether it gets appealed further up to the High Court. Also, you referred to years in question. So, for example, if there was a UPE in June of 2022, it is now that the trustee and also the advisors are going to have to think about, well, how are they going to treat that? So if we go back to, for example, a distribution made in June of 2022, then that would have become potentially a loan by lodgement of the 22 return, so sometime in early 2023. And then, if it is indeed a loan, it would need to be managed by lodgement of the 23 return of the company, which is roughly May of this year. So there may well be a reasonable approach where people are focusing on distributions made in the 24 year, given we've now got Bendel in play. But in fact, it could be 22 or 23 distributions that are actually affected at the moment, or will be certainly by lodgement day this year or looking at June 30 this year. So as you say, we don't need to do anything right now, but I would hope in the months ahead that we would see a little bit more guidance from the ATO on what practitioners can do. They have already issued a decision impact statement in an interim form back in November last year. So perhaps they won't issue any further guidance beyond that, where they've stated we will stick with our current position until we're told otherwise by the courts.
I think you're right, Robyn. This is yet another area where practitioners can't necessarily give a definitive answer to their clients on what they can and can't do, but more a position as to, well, this is where the whole matter sits at the moment. These are the options you've got. These are the potential downsides and upsides to each of them, and making an informed decision, or advising their client so the client can make an informed decision based on where they wish to go. So it is one that hopefully we do see this federal court decision, and if it does proceed that far, the High Court decision, and get a bit more of a definitive set of ground rules as to how to manage UPEs with corporate beneficiaries. But in the meantime, it's just another one of the areas of tax where we're all sort of sitting there looking forward to where this takes us.
We should get our popcorn and sit and watch watch this play out.
Said like a true tax person, Robyn, but certainly you're not going to get me disagreeing on that.
Yeah. All right. Now, very briefly, the multinational package. There's a bit going on in this space. So can you just briefly run through some of the key points that this particular package is looking at? Because we know that people like to have a go at the multinationals and say they never pay enough tax. In fact, they are one of the best taxpayers in terms of the gap, the difference between what they should be paying and what they do pay. Nonetheless, we've had some fairly significant tax measures come in the last decade, and we've got some tightening up of some of those rules.
Look, we do. And I think this is where the multinational area continues to be a focus, and it continues to be one where the costs of complying or the technical issues just keep growing. Be it in this instance things like thin cap, anti-avoidance rules for denying deductions for certain payments relating to intangibles where they're related to low or no tax jurisdictions, reporting requirements to enhance tax disclosures, debt deduction creation rules. There's a whole range of things that they require not just necessarily an Australian coordinated response, but also knowing the broader group that an entity might operate as part of. And that's certainly something that for multinationals, be they smaller multinationals in Australia, larger ones, it can touch, these things can touch a whole range of businesses that operate cross-border. And I think that's where these packages and the issues where the Bendel type case may have been something that the SME area, it's a hugely important thing. I think those who practice in the larger end of town or the cross-border type end, these multinational things and the continuing evolution of packages relating to multinationals and tax issues there, this is just going to be another year where there's more measures that keep tightening things and requiring a very robust compliance approach for taxpayers, and also a robust set of planning to manage the issues so that there's not inadvertently achieving unintended poor outcomes for taxpayers.
Moving back to the ATO and away from Treasury, we've seen a firmer and quite definite shift in the approach taken by the ATO when it comes to debt collection. So we know that during the pandemic, they were going really softly, nice and gently with businesses. They didn't want to send them under. And we had payment arrangements being offered, and we had remission of the general interest charge. We had, if you like, a halting on things like garnishee notices and those sorts of firmer actions. But all this is cranked up, including director penalty notices. So again, as a practitioner, what are you seeing out there? What are you hearing? And how do you think this is going to play out when we've got still a very high level of collectible debt owing by, in particular, small businesses?
Look, I think it is one, Robyn, where you know, the government probably needed to go back to business as usual on debt collection. That it was very very carefully managed by the tax office during that COVID sort of period, and trying to give businesses the best chance to survive through that period and come out and continue on. But the sheer size of the debts that are sitting there, it's just massive, and so it does. You know, people who genuinely need some assistance and some time to pay it off, making sure that they get that time and assistance from the tax office is important. But equally, those who will never be able to pay it off, unfortunately, the decision does need to be made, and sort of making sure that those debts are managed appropriately, because we can't just have debts continuing to balloon, forever. Ultimately, they do need to be paid or managed, and so I think it is going to be a year where, because we have had interest rates increase, debts will grow a lot quicker just because of the interest component adding on top as well. So the ability to manage some of these debts will continue to be harder for those who don't have the cash flow and don't have the ability to pay it off. So speaking with an appropriate advisor in that area is probably quite a useful thing for those businesses who are just not sure whether they've reached a point where it's actually their debt's too big or how best to manage it.
To put some figures to the large amounts you're referring to, in June of 2019, so about 6 months out from the pandemic, we had collectible debt at about 26 billion. Now that increased 89% to June 2023, so over a 4-year period, to more than 50 billion. And about 33 billion of that is owed by small businesses. So it is disproportionate given the contribution and the extent to which we have small businesses in the economy, given, of course, the turnover and the tax they pay. So it is a concern that collectible debt has gone up. And I'm not talking about debts that aren't collectible. These are amounts which are regarded by the ATO as still being recoverable.
Look, it's a big number, and I think of that number, there's a lot of them that will have just needed some short-term breathing space. Others where perhaps they are using the tax office as their pseudo bank, and perhaps that's not the right mindset to have. And actually coming up with a payment arrangement that they can manage, that they can work with, and that chips away at the debt over an appropriate time frame is really important. So picking up the phone to the tax office and having a chat to them about it, and equally the tax office hopefully being reasonable in setting a payment arrangement that will work in a sensible time frame.
Many of our listeners may be aware that there was an announcement in the mid-year and economic and fiscal outlook in December, which announced the government's intention to make general interest charge and the shortfall interest charge, which is a lower rate, non-deductible from, I think it's 1 July 2025. So this is something that will have quite a big impact, because there may be businesses that have debt, but the way they're prepared to manage it is, yes, we know it attracts interest, but at least that interest is deductible. Once that deductibility is taken away, then it becomes a much more significant cost to have an outstanding tax debt.
Oh, that there's no doubt about that, Robyn, and I think it's yet another measure that's encouraging people, whether it's with the carrot or the stick, to pay their tax office debts and make sure that they're up to date with those. So it is something that, for those businesses that are paying their debts on time, there's an element of probably fairness to them. For those who are not, it's an increased cost that suddenly they're having to pay their tax office debts, and that interest not being deductible increases the cost of that debt. So it is one of those things that it will focus the need for some businesses to make some hard decisions on how they get themselves out of this.
Moving to superannuation, 2 major reforms, proposals, measures on the horizon, and one of them is a little bit closer than the other. We've got a bill before Parliament currently, which is due to commence and take effect from 1 July 2025. In the tax world, us often call it Division 296 because that's where it sits within, or will sit within, the 97 Tax Act. But in layman's terms, this is the additional 15% tax on earnings from superannuation balances above $3 million. Now, there may be many out there who say, I wish I had $3 million in my super fund. But for those who do, this is certainly going to be a significant change. Now, most across the profession agree that if the government wants to increase the tax rate, not only is its prerogative, but those sorts of policies come and go all the time. The biggest noise we're hearing around this particular policy is about the proposed taxation of unrealised gains in calculating those earnings. Again, your thoughts?
Look, it's absolutely right, Robyn, that tax rates go up and down, for forever and a day when there's been a tax system. But the taxing of unrealised gains, that's the big one. That's the really big one here. And I think some of the concerns from people that, hey, I'll be taxed on a gain that's unrealised that I may never realise, so I'm paying tax on an amount that I never actually get. And where's the fairness of that and the appropriateness of that? And I think that's the discussion and the real issue that a lot of people are finding very, very tough to get their head around. And I think probably more broadly, making sure that if this does come in as a measure, that it doesn't spread out into other parts of the tax system and suddenly become a norm across other areas, which would create, because we don't want this to create a precedent in that regard, because it suddenly it will fundamentally change behaviours. And is all of it a good change to behaviours or not? Making sure that the superannuation system and the cost to the tax system that superannuation has is sustainable into the long term is an important part of government decision making. There's no question around that. But dealing with it in a fair and reasonable manner and taxing unrealised gains, is that fair and reasonable? I think that's where a lot of people are finding this one a particular challenge. So how Div 296 evolves will be an interesting one. And obviously we'll have a federal election between now and when that kicks off. So will that become an issue from a political point of view leading into the next election? Who knows?
My explanation of it in layman's terms is, instead of using a profit and loss statement, which is actual earnings of the fund for that particular member, they're instead using a movement in balance sheet approach. So the balance in your superannuation accounts. And unfortunately, the balance in your superannuation account is the unrealised gains that are embedded in these assets. And that's what they're effectively going to be taxing. So that's why, we're keeping a very close eye on this. The other measure, which is a year later, 1 July 2026, but no less significant, in fact, I would suggest this has much broader application, is what's called Payday Super. And we're going to see a requirement of all employers. At this stage, there is no carve-out, no de minimis rules, where employers will need to pay their superannuation guarantee at the same time that they pay their salaries and wages. The Tax Institute, and in particular myself, has been directly involved in targeted consultations. And having sat through a number of these meetings, and I'll say that many of them have not been confidential, so I am free to discuss these with you now, it's been very pleasing to see the collaboration, the openness to ideas, the tabling of issues, thinking through all the aspects and all the different stakeholders. It's not just a change in timing of payment. It's going to affect the onboarding of employees, the gathering and sharing of information, the development of reporting systems, how the ATO ascertains whether there has been, in fact, a shortfall. It's going to necessitate a whole design and redesign of the guarantee charge. So when we look at this current 11%, moving to 11.5% and eventually to 12%, it's not just that the charge is imposed, but all the draconian penalties that come with it. And that currently operates on a quarterly basis. So to start moving it to a weekly or a fortnightly does need a rethink. So without going into any more detail, I see this as a golden opportunity to bring this very archaic regime, very necessary, but the regime itself is over 30 years old, and bring it into the 21st century. From your client's perspective, are they going to welcome this? Is this something that they are going to be concerned about? Where does the business community sit on this?
Look, I think the vast majority of businesses do the right thing by their employees, and they genuinely pay the right amounts of PAYG withholding, super, all that sort of thing for their employees, pay them their wages, comply with their STP and other obligations. And so this will probably, from a compliance point of view, be more of a cash flow type of thing, where it's a managing cash flow that at the moment they may be paying the super quarterly. This will require it to be paid earlier and in perhaps more bite-sized chunks, but that cash flow change will be important for a lot of businesses. The degree that interacts with, if you look at the size of the ATO debts the sheer growth in the size of that's probably indicative of how tough some businesses are finding their cash flow at the moment. So is this going to be another thing that weighs on cash flow for businesses and creates bigger problems there? That's a question that I think needs some more delving into, and there's a whole separate issue there. But I think you're quite right, Robyn. The SG penalties, the broader rules around super and the mischief or non-mischief and the degree of a penalty when a business has genuinely tried to comply with their obligations but perhaps has an inadvertent error or mistake there, and is the penalty that they cop for that fit for what has actually occurred? I think it's the right time to relook at all those things. And so I'd love to see a broader piece here. And we've got time. That these measures are not proposed to apply for well over 2 years. So I'd love to see that. And it's refreshing to hear that there is genuine breadth of consultation, ideas, thoughts coming together, and hopefully we land on something that's user-friendly and able to manage things appropriately.
We would certainly want to see a much more proportionate penalty, so that if you're 1 day late versus someone who never pays on behalf of their staff, they are treated differently, and as they should be.
As you mentioned, Robyn, with super heading to 12% for SG, and it started at a much smaller number than that many years ago. So the cash flow impacts, the quantum of the penalty because of how it's calculated, it suddenly can become a very big number. So we need to make sure that it's fit for purpose.
Now, turning to the integrity of the tax profession, and I know that we could speak for a long time on this alone. We ran a webinar for our members, which is available on the member portal at the end of last year. So if members want to go and look at that from the Tax Institute, they can delve into it in much more detail. Very broadly, we've got some major legislative changes coming in affecting the regulation of tax agents and BAS agents. Some law has been enacted, some is before Parliament, some is still in the pipeline. So there are quite a number of stages being rolled out. At an overarching level, the approach to this, it's certainly appropriate to look at improving the integrity of the system, but at the same time, it is also valid for genuine concerns to be raised about the design of the provisions.
That's right, Robyn. I think that we fully support that the government wants to ensure that there is a high degree of integrity in the tax profession and that the profession does engage in ethical conduct. I don't think there's any issue with that. I think the vast majority of tax practitioners do operate in an appropriate manner, and they are fully aware that society should hold them in a high regard, and they want to be held in a high regard as someone that can be trusted to act appropriately, ethically, with a high degree of integrity, where, yes, they are looking after clients and taxpayers, but they are doing so within the bounds of the tax laws in an appropriate manner. And so, yes, some have overstepped the mark. There's no question about that, but the response needs to be commensurate with that. That those who are operating at the fringes or even well outside the fringes, they should be dealt with appropriately. But we need to make sure that the measures here don't lead to the everyday client being unable to access tax advice and assistance because of cost effectiveness or that sort of thing, because tax practitioners are so burdened with the red tape or the regulation they need to go through to just be able to get a client onboarded or to be able to document things or deal with it and so on, to be able to give advice to clients. We've got to find the right balance there and make sure that we don't price the everyday Australian out of getting good quality tax advice from a tax agent and tax advisor, but we need to manage the integrity of the tax profession and ensure that tax practitioners do act ethically and do act in a way that is where the community expects that practitioners should be operating.
Thank you. And finally, your vision as president. So you've got a year ahead, and we've probably got you at the calmest point of your year. It's only going to ramp up from here. And you will, of course, be traipsing around the country, going to lots of our events and other activities and meeting with members and looking at our advocacy work in terms of looking at submissions and so on. What do you hope to get out of the year for the Tax Institute? What direction do you want to take the Institute in, and where do you think our focus will be?
Look, as an institute, I want to make sure that we have got the offerings that are right for our current and future members, that we're bringing through the next generation of tax practitioners. And that can be a broad range of things. If you look at something like our Tax Academy that's just recently been launched, the bite-sized chunks of micro-credentialed learning, that is a fantastic set of tax learnings there where you can take the opportunity, if you're a novice in the world of tax, to upskill. If you're a strong, experienced practitioner but want to upskill or refresh in certain areas, you can take some bite-sized chunks of learnings out of that. It's technically very strong. It's practical. Great set of things there. So Tax Academy is something that we've built to help be the way that people want to learn. Bite-sized chunks on the go, but for a breadth of people who it's not just aimed at the novices or the experts. It's for everyone. As you say, Robyn, I'll be going around the country. I'm really looking forward to meeting members around the country, hearing what they've got to say, helping advocate for the issues that are affecting them, and also taking the tax profession forward in an appropriate manner. I think one of the real strengths of the Tax Institute is the sharing of knowledge, the experience and the skills. And I think that's something that we need to make sure is fit for purpose moving forward as to how that is. We run some fantastic events where our presenters freely give up their time to both present on the day, but also write their papers, share their knowledge and skills, and put back into the tax profession. And that's something that I want to make sure that our tax community continues to work together to pass the baton on to the next generation, but also help design a tax system that's fit for the future. So our advocacy, sticking up for the tax profession, not just providing one-sided views, but a balanced consideration of what is good for the tax profession, and also for members, raising issues that, and obviously for part of your role, Robyn, is taking forward issues that members might have and helping them get those resolved if they've got issues along the way. So supporting our members, our practitioners, our tax community to really make sure that as a profession, it's an attractive profession to be part of. It's an interesting and exciting one. It's a fulfilling one, and that it's one that we are fit for purpose for the future. So I want to help take the tax profession, the Tax Institute forward, and that's something that really excites me. So I'm looking forward to 2024, Robyn. I'm looking forward to working with the team at the Institute. I'm looking forward to working with the members, with the broader tax community, to be able to achieve a lot of things this year.
Well, thank you, Todd, on behalf of the staff at the Tax Institute and all of our members and the broader profession. Thank you for your commitment over many years. You don't just become president overnight. It's many, many years of voluntary work up through our working groups and committees and State Council and then on National Council. So congratulations again on your appointment as president. We look forward to your energy and your drive and the vision for this year. And let's roll our sleeves up and get into the work.
Thanks, Robyn. I think it'll be a cracker of a year for the world of tax, and I'm looking forward to it.
Terrific. And thank you also for your time today.
Thanks, Robyn.
Thanks for listening to this episode of Tax Vibe. I've been chatting with Todd Want CTA, President of the Tax Institute and Director, Tax Services with William Buck in Sydney. If you've enjoyed this episode, we'd love for you to subscribe, rate, and review Tax Vibe wherever you listen. We welcome any feedback and suggestions. To catch all the latest from Tax Vibe and the Tax Institute, join us on LinkedIn. If you're interested in being at the centre of the tax conversation, a membership with the Tax Institute could be just what you need. Stay current and connected with tangible, real-world benefits. Learn more at taxinstitute.com.au. Thanks again. Till next time on Tax Vibe.